In this final part of this chapter on books of prime entry, we're going to have a look at the final book of prime entry that you could see, and that would be the petty cash book. Now, we're not going to look at the journal because we have done journals all the way through this course already, so this is really the last book of prime entry apart from the journal that we'll see. So the petty cash book, this is recording or receipts and payments of cash in hand. So cash that is in your petty cash tin on your premises. Now usually petty cash is, as the name suggests, cash for small items of expenditure. So for paying for, tea and biscuits, for paying for postage, maybe some taxi fare or train fare. So it's really for small miscellaneous expenditure. But that expenditure is still an expense in the financial statements. So we still need to record it in the book of prime entry, and we still need to post the totals to the main ledger for posting to the financial statements later on. So we can see then that we have a slightly different layout once again. What we do is we have a receipt column first of all, and that's going to show all the receipts in to petty cash. And can you see there, the receipt is $100. We then have the date, and we can see that from the bank, we received in $100. So could you think of the double entry then? Well, we'd take money out of the bank and credit bank and debit the petty cash asset account. We looked at that in chapter 3, if you remember, the cash in hand account. So let's write this in here. In order to put money into your petty cash tin, you need to debit petty cash asset and increase it up, and credit and reduce your bank asset, so your cash at the bank. Okay, and they did that on the 1st of December. We can then see that we've got several items of expenditure: tea and coffee, stamps, and some biscuits as well. So we can see then that all the cash paid out of petty cash, the 5, the 10, and the 2, have been totaled up at the bottom as $17 that has been paid out of petty cash. What we then must do is analyse those payments out of petty cash. Is it for postage or is it for refreshments, tea, coffee and biscuits? So very similar to cash payments book, if you remember. We show one column showing the total payments out, and then we analyse the expenditure that we've paid out. Now, as always, we always post to the main ledger from the totals. Okay. So the total of the cash paid out of petty cash would reduce your petty cash asset. So we would have to credit and reduce petty cash asset to reduce that $100 that we put in from the bank. Well, every debit and credit must have an equal and opposite entry. So 10. Well, 10, that's going to be a debit to increase the postage expense account. Okay, and increase our expense of postage. The 7, for refreshments, well, of course, that's going to go to the refreshments expense. So debit refreshments expense. And can you see the credit in the reduction of the petty cash asset equals the 2 debits to postage and refreshments expense? Now, because this won't affect receivables or payables, there's no control accounts, nothing like that. It's just a day book with postings to standard main ledgers. There's no subsidiary ledger involved. So, what I thought it'd be useful now is to see what the petty cash ledger account looks like and remind ourselves of that, and then do the credit entries as well. So, if you open up a T account, a ledger account, and call it petty cash, we're going to have the balance brought forward from the bank of 100. Okay, that would be the money paid in from the bank. Now, what we call that is the float amount. We always want to maintain a fixed float within petty cash to keep control over it. And that's going to be through an impress system, which we'll discuss momentarily. We'll then post the credit for our vouchers. And that's going to be all the expenses paid out of petty cash. But every time we pay money out of the petty cash tin, we're going to write a little voucher and attach it to the receipt of the expenditure so we know how much expenditure has been paid out. Remember, petty cash is an asset. If you've got $100 sat on your premises, that's a lot of money. You know, it could go somewhere. So we have to keep control over it. And we write a voucher for every different type of expenditure we pay out. So every time we buy a pack of biscuits and we take money out of petty cash, we'll write a voucher and put it in the petty cash tin. So $17 is what is being paid out of petty cash. Now, at the year end, or even at the month end, I would say, with petty cash, what you must do is restore your petty cash to its float amount, which we said was $100. Leave this T account blank, and let's talk about this idea of float and this idea of a impressed system. Okay, an impressed system for petty cash. Well, what we say with an impressed system is that a float amount is decided and withdrawn from the bank. So if a business decides to operate a petty cash system using the impress system, they need to decide what amount they always want to maintain as float within the petty cash tin. In this particular example from the daybook, the float amount would be 100. That's the fixed amount that they've decided, and they've withdrew it from the bank. Payments and receipts are recorded in the petty cash book and any expenditure or receipts must have a voucher. So if you spend money on biscuits, like I said, you're going to write a little voucher, call it voucher 1, expenditure for biscuits, authorised by whoever is authorised to manage petty cash. We'll staple that to the receipt that we received from the shop for those biscuits and put it in the petty cash tin along with whatever cash is left over. Now, you could receive money into petty cash as well. Maybe you receive some small amounts of money. Maybe you've made a small sale of some kind. Well, again, if you've made a sale, then write a voucher. Sale of $10 for stationery, let's say. Okay? So you could have receipts. Okay, so money coming into petty cash as well, other than withdrawals from the bank. So what we need to say then is that at any point in the petty cash system, the float amount will always be maintained. And that float amount will be made up of cash and vouchers. So if we think about the petty cash book we've got in the notes, we said that the float amount was $100. How much did we pay out of petty cash? Well, if you remember, that was $17. So that's the voucher that's kept for each item of expenditure or receipt in. So we'll just make a note here, vouchers, expenditure, minus receipts of money in, not to be confused with the receipt you receive from the shop when you buy goods. which means then that the cash left over would be the balancing figure, and that would be what? $83. So what is in the petty cash tin at the minute is $83 cash and $17 worth of vouchers that are kept for the expenditure on postage and refreshments. So you will always have that fixed level of float made up of cash and vouchers at any one time in the petty cash tin. What we then go on to say is, periodically, the value of the vouchers is topped up with cash from the bank to restore the float to cash. So, at the end of each month, let's say, the total expenditure that we've paid out, which we said was 17, that's how much we're going to withdraw from the bank. So what you would do is credit your bank account with 17 and debit and put $17 into petty cash, which means your float will still be 100, but then your cash would also be 100. Okay, so maybe once a month or once a week, it depends on the level of expenditure, you are going to top up the petty cash box with the value of the vouchers, and you're going to top it up with cash from the bank. And that's going to make sure that you've never got an amount of money over $100 within petty cash. Okay, so you're never going to have too much cash, but also you're never going to find a situation where you never have enough, because you're recording and analysing your expenditure as you go through recording those expense vouchers. So by operating an impress system of petty cash, it ensures good control over your petty cash asset, your cash in hand. So, if we go back up to the ledger account, at the end of the period, we are going to put money into petty cash from the bank, and we're going to restore petty cash to its float amount. So we'll credit $17 out of the bank and debit the petty cash asset. So at the end of the period, the balance carry forward is $100, and that's the asset that you'll bring forward into the next period. So notice then that the opening and closing balances will always represent that fixed float amount at the start and at the end of the period. Okay. So for petty cash, if you're using an impress system, the opening and closing balances of the asset in the ledger account would represent the fixed amount of float that was been determined once they started up the petty cash system. And there we have it. That's how we deal with petty cash. We record it in the book of prime entry, we decide on a float amount, and then we record it into the main ledger by posting from the totals. But I'd say one of the most important points from this, especially for the exam, is this idea of float equals cash plus vouchers. And there we go. And that's the end of Books of Prime Entry. Thank you.